Hi, everyone. John DeRelay here, Head of Revenue Management Education at Wheelhouse. And today we're going to do a data deep dive into Southwest Florida markets, such as Fort Myers, the areas around Naples, and Rotunda West. So today what we're going to do is we're going to dig into a little bit of market data, have a little bit of a conversation about what we can kind of expect and what might be going on. I'll talk to you a little bit about some macro trends that we're seeing, and we'll talk a little bit about the pacing. So it should be a good opportunity to kind of look into what's going on, particularly as we kind of hit these Q1 high seasons and see how 2026 is going to start to come together for us. Before we get started and jump into the data, I just want to remind everyone that this is a Wheelhouse sponsored event. It's part of our series of data deep dive town halls and deep dives where we look at market data and sometimes bring in local property managers and revenue managers to have a conversation. We will be using Wheelhouse market data for this. This is all market data that you can access for free, whether or not you're a Wheelhouse customer. It's a great extra source of kind of like high level market data. In addition to that, I'll mention things like pace and what's going on in your portfolio. And if you don't have good tools to see your own pacing, even your occupancy, how you compared to last year, how you compared to same time last year, bringing that all the way to the daily level to see which days are pacing well, which days are pacing poorly. Wheelhouse does offer a performance insights tool that is freely available for everyone. In this tool, you can see all of your pace, all of your same time last year. You can bring it all the way to the daily level and really see at a granular way what days you need to make adjustments on. And that is free for everyone. So if you need some additional tools to be able to maximize your revenue this year, let us know. We're happy to get you trained. Okay, let's hop into some data. Okay, so if you have been to one of our data deep dive town halls, you know that I do like to kind of look around and see what is going on in the region, kind of from external sources, just to help people kind of see and connect all the dots, and also to show you that there's a lot of sources of data, and whenever looking at market data, it's really important to combine stuff. One, so that you can make sure that you can trust the data. Two, if you're talking to owners or talking to other stakeholders, you can give different sources that really build credibility, make it easier for you to get across what you're trying to get across. This first piece I have for you is the Visit Florida website. Visit Florida is great. Often CVBs have a lot of great information. First thing to note here is I have pretty limited access. I am not a member, but as you can see, if you are a member of Visit Florida, there are actually quite a few really good options that they have. They provide Smith Travel Research reports. That's a great tool to get an idea of what's going on in the market because that is true hotel data. So Smith Travel Research reports are great. That could be a great tool for you if you have access. You can also see SCIF reports, which are hospitality reports, as well as their own data dashboard. So if you are a member, there's some great additional information you can get from Visit Florida. For now, I'm just going to look at some of the data they have freely available, which is high-level Florida data, just to point out a few things. One is they haven't done Q4 yet. I'm sure that'll be coming out pretty soon. But as you know from 2020, from the first 3 quarters of the year, for a lot of people in our industry, it was arguably a pretty tough year. We saw a lot of pressure on the occupancy. We saw a lot of pressure on the rates, and we had a lot of competition. Overall, though, for the state, the first 3 quarters of the year were pretty stable. We saw that there was pretty decent amount of visitors. Both domestic and overseas grew a little bit, and a lot of that was kind of offset by the fact that Canada, which is a really large traveler source, really dropped a ton. And so I'm going to bring this up again because this Canada piece is really important, especially if in your portfolios you have lots of Canadian travelers. For some parts of Florida, this has meant snowbirds. For other people, especially in West Florida where you have these longer stays, this may be something that's really impacting you and something you really need to be paying attention to because Canadian travel is down substantially compared to basically across the first 3 quarters. And as I'll show you in a second, that's going to be true across the board. Now, just to give you an idea of how much Canada is important to Florida travel, when we look at visitation by country, it is by far the largest number of visitors by almost 3x the next largest visitor pool. So Canadians make up 3 million. Brazil in second place is 1.1, and the United Kingdom is 1.1. So when we look at this, we see that this Canadian travel drop is pretty substantial, and it doesn't really look like it's going to change. I also have pulled up here an article. 2025 Canadian tourism is down 15%. This one has been updated very, very recently, so the beginning of the year. Now, this article doesn't seem to have the Q4 data. That doesn't seem to be released, but it does have a few little tidbits. And honestly, I think it's probably Q4 isn't going to make this better. It's probably going to make it worse. There is kind of a national trend that happened around the country, which is Q4 this year was really, really weak. So even though people had pressure starting at about the spring, sometimes through the summer, once we hit about September, things got pretty honestly got worse across most markets. So I wouldn't be surprised if these kind of Canadian travel trends actually got worse for Q4 and make those overall numbers a little bit worse. Now, there are a few tidbits in here that are kind of interesting. They do talk about some preliminary hotel stuff, which looked like it was a little bit down too. Again, mostly Q3. So it's talking about kind of what I'm saying is that as we got into Q4, things got worse. But I think this is a big piece and probably one of the bigger pieces to pay attention to for people right now, because this Canadian tourism is down and it doesn't look like it's coming back anytime soon. There is no news or trends that indicate the Canadian travel is going to recover anytime in the short term. So if you go through your reservation lists and your past guests and your history, you really need to think like, hey, am I exposed to large Canadian travel not coming in? Do I need to offer them different deals to try to get them to come in? Do I need to find other ways of bringing in customers? Because this could be a pretty significant hole if it's been a major part of your revenue generation to date. Okay, so let's hop into some market data. I've got 3 market reports pulled up here. I have Rotunda West, Cape Coral, Fort Myers, and Naples, Florida. So we're really covering a lot of this Southwest Florida area. I'll zoom out so we can see, although I imagine you know where these are. And just so you know, later in the week, we'll be doing Sarasota and Bradenton and Tampa. So we'll kind of be covering this whole West Florida area. Been a lot of hurricane activity, as you guys know, over the last couple of years. So that's definitely going to have an impact on numbers. But let's just hop in and tell a little bit of a story. I'm going to start with Cape Coral because it is our largest market area by far. You can see here that this is 12,000 listings, whereas Rotunda West is about 3,700 and Naples is about 8,000. So it's definitely our largest market area that we're looking at today. And I'm going to go over here to the trends section. We'll start just on adjusted occupancy. I think occupancy is a great place to start when trying to build a story of what's going on, mainly because occupancy represents your demand, right? It incorporates supply. It shows you like, are things up? Are things down? It's also a great way to tell a story to an owner, I think, because frankly, owners understand occupancy. There's a lot of complex KPIs in our space that we know about, but at the end of the day, an owner can look at this and know if things are going well or going poorly. So we're looking at the entirety of the market area that includes all bedrooms, all performance types, hosts, professionals, that kind of thing. And so just the overall market situation. And when I look at 2024 and 2025, you can see that the year was a little bit tough, right? Starting out in Q1, we see that there is pressure on the occupancy basically from the beginning of the year, right? This is coming off of some of the hurricane stuff and especially the tornado stuff that hit Fort Myers after, I think it was Hurricane Milton. Excuse me if I'm incorrect on that. I live up in the Pacific Northwest, so I don't remember all the hurricane names. But starting off the year, a little bit of pressure on the occupancy. Part of this is probably because, as most markets in the country, we've seen pretty significant increases in supply since COVID. And, the demand growth, while still growing in most markets, hasn't been growing to pace with the supply. Now, this is a little different than other parts of the country. Most parts of the country, ski markets aside, because they operate really close with the weather, Q1 started out pretty strong. There was really good early booking at the end of Q4 2024. And people were pretty optimistic that 2025 was going to be a good year. Now, you guys saw pretty early that there was pressure on the occupancies. But for most of the country, it wasn't until March, April that we really just started to see that pressure show up and start to have shortfalls in the occupancy. Now, that trend is true here. We see that March is lower. Some of this could be Easter, but frankly, it's not made up for with the late Easter. And really through the rest of the year, all the way until July, maybe August, we see that these shortfalls just persist in the market. That means if you're pricing properties, you're probably losing ground on ADR. You might have vacancy and you're making a little less money unless you're being really, really savvy in the marketplace. Now, another kind of trend is once we hit September, this is true kind of nationally, we see substantial shortfalls around the country. So this seems to be the case here. Once we hit September, this pressure on the occupancy seems to get quite a bit worse, and it remains like that through the end of the year. So overall, pretty tough year in 2025. Now, something I do want to point out is that if you're a professional provider or you've got really top properties, you may not be feeling the same kind of pressure. If I look at just the highest performing listings, so this is like the top 15-ish% of listings, you can see that there's a lot less pressure on the market, right? Q1, while still under a little pressure, has much higher occupancies and much less loss year over year. We do make up for some of that Easter moving between April and March, maintaining, and the summer drops are there, but not quite as strong. Now, that trend in Q4 is still there. We do see a pretty substantial loss across Q4, but this is something I think that's important to bring up. When we're looking at market data, you need to know if you're looking at like these professionals or if you're looking at kind of the market as a whole, because there's a lot of people out there and the customer has a lot of options. That's, I think, the most important thing to bring up is that professionals are in a position to take more market share, and they should, but you do have to consider when you're thinking about your rates, especially when a market is under pressure, is how much choice does the consumer actually have? Because as you can see, those high performers are taking a lot more of the market share, but if you're a consumer and you're looking at a bunch of different prices in the markets, you may have a lot of choice when making your decision because there's a lot of properties that actually are vacant between 2025 and 2026, or 2025 and 2024, sorry. Now, let's take a look at 2026, because this is really the important thing for us to understand is how are these markets pacing right now, right? Are we on track to have a better year in 2026? Are we on track to maintain? And frankly, it's a little bit of a mixed bag right now, right? So January is definitely behind right now. We're about 5% behind where we were last year. Around this time, we were at 21%. So that's not very good. It means like we're halfway through January. That means it's going to be really hard to recover. If you are holding rates in any way, you really need to shift to an occupancy forward strategy and just try to take the market share on occupancy, because it's going to be, even though that ADR may not be where you want it to be, it's going to be worth a lot more than vacancy. The story switches a little as we get to February and March. And once we get out into February and March, we actually see that the market is pacing ahead. And actually pacing ahead by a pretty substantial amount, right? This 26% is about 10% higher. We were at around 15% last year. And then for March, we were at around 5%. We're at 15%. So the early booking, February and March, is looking really good. Now, what's curious to me is if that will start to slow down as we get into the window, because there's still a lot of properties to book. There's still a lot of things available. And that means prices might start to move. So it means you really have to be paying attention and being really reactive to the market in order to capture that market share. And this is kind of a trend we've seen in a lot of areas, both last year and this year, which is early booking looks really strong, but then things slow down and get a little volatile in the short term. So I think the kind of name of the game here is you really need to be on top of your revenue strategy. I would advise that you maybe take a more conservative approach on rate position. Market conditions both in Florida and across the country the last 2 years haven't been as optimistic. And so the more optimistic you are on rate, the more risk you're taking. And I think it's just better off to be in a lower risk position here and try to focus on filling the occupancy first. At the end of the day, your owners are going to be happier if you left a little ADR on the table and things end up being good than if you ended up vacant when things were bad. Now, so that's kind of interesting to me. I think we've got this kind of mixed situation here where like January, not looking very good. A little bit worried here because I'm unsure. I didn't go back and see where January was a few weeks ago, 3 or 4 weeks ago. I don't think it was quite as bad. So it could be that there are events going on in the kind of macro world, economics and political world, that is causing short-term booking to slow down. It's something you have to bank on, that when these big events are happening, people slow down on spending. And so you really have to be aware of, if you were pacing well, What happens if that changes very quickly? And are you watching your bookings fast enough to really see if there's a change so that you can react to it quickly? That could happen as we get into February and March. This pacing could start to slow down if there's things happening, and you just need to be on top of it. And that's where I mentioned being a little bit more conservative. Now, the other thing I'd like to mention here is we do have pretty good early booking when we look out at April, May, June, and July, right? There is occupancy on the books. We are seeing this increase week over week. So we're putting more on. And again, it goes back to that early window is really, really strong. Early booking remains strong across the country. People are either planning ahead or planning very short term, and we're kind of missing that middle. And what that means is you really want to make sure your pricing is in line. You want to capture that early booking. And the most important way to do that is just make sure your pricing is reasonable. If you still have big premiums on your rates from COVID, you need to be stripping those off and get your pricing into a reasonable point. If you are seeing that your pricing is way higher than what you actualize on average, you probably want to reconsider that so that you can get those early bookings and be in a position to take a little more risk on ADR as conditions change in the mid-term and short-term window. Now, very quickly, I do want to just take a look at what the highest performers are looking like. This has got an interesting trend to me because the market as a whole is actually pretty well occupied for February, but it does seem to me like we lose a little bit of that ground in February, March. To me, that might mean that some of the top properties are actually holding high rates. We'll double check that, but that could be a risk. It could be that the consumer is actually telling us, we're not going to book the best properties. We're going to book the properties we can afford. And that's another little indicator that like maybe you really need to reconsider where your ADR is and get really realistic, because the bookings are coming in. The pacing is good here, but it's not being reflected the same way in what we would normally consider the top properties historically. And so that's kind of a red flag to me. Now, let's look at something else here. I'm going to look over at asking rates. So asking rates are the average rates that people are posting and advertising in the marketplace. So it's like where occupancy shows how demand is coming in, asking rates show how supply is. And the thing to notice at a glance here, we're looking at all the listings, is that generally speaking, people were pushing rate a little bit year over year between 2025 and 2024, even though occupancy was down. To me, that means that the market is pushing rate up, but not really reacting to the fact that demand is under pressure. Now, let's take a look at what's happening in 2026. And this is something we see. We see kind of a similar trend, right? That people are pushing rates across the board. Now, for February and March, that might be kind of a good thing, right? We're seeing these rates kind of go up. We're seeing pacing overall in the marketplace really good, but we got to make a connection here. Like, the stuff that's getting booked may not be the most expensive stuff that's being advertised, right? So if we look at average ADRs, we can see that rates are pushed a little bit, but not near as much as what's being advertised. This is really, really key, right? Is that the pacing that is occurring, the pacing ahead that's happening in February, is not happening at these exceptionally high rates that are being advertised. It's happening at a lower rate. So people are buying a little bit cheaper inventory in the market than what's being advertised. And what that means to me is if you're following market rates might be a little too high. The people that are getting the bookings and are pacing ahead are actually a little lower than where the average market rate is. That's important to note. You need to be really checking your own pacing and where your own rate position is, because it does show in these ADRs that there is ADR growth available. People are booking a higher rate, but it's nowhere near as high as just following what the market is doing, right? Now, another thing I think to take a look at here is last summer was not very good. We saw a lot of attrition across the year, and these rates out here that are being advertised are pretty high, right? So right now the market is just kind of holding premiums in general. And, there's a lot of room to do better if you have a really realistic rate position, particularly out as we get into April through July. And so if you're an early mover there, like I mentioned, there is early occupancy on the books. You really want to be capturing that occupancy so that you are ahead of the game and can hold your rate a little longer in the midterm. Okay, so that's a pretty good view over kind of Cape Coral and Fort Myers. Just a swift recap, I would say that pacing looks pretty good, except for January. Get your stuff in for January. The markets may be a little overpriced because ADRs are coming in, they're coming in a little lower compared to how high the average advertised rate is, and that means that you really need to be realistic about where your rate position is and try to capture some of that early booking. Now, Cape Coral and Fort Myers are really going to give us a pretty good view of the general trends. A lot of these markets are going to have really similar seasonality, so we'll take a quicker look at those. So if you've been waiting for me to cover Naples or Rotunda West, I think you get a lot. We'll see a lot of similar trend here. But let's take a look. So we'll start with Naples. It's the next biggest market area that I have, 8,000 listings. I'm going to go back over here to the trends section. And let's take a look at the occupancy. So I'm going to pull off a few of these. We'll look at 2024 to 2025 first. In general, we see a really similar trend to Fort Myers and Cape Coral, right? Basically, every month has some attrition on the occupancy. So the entire year is under pressure from an occupancy perspective, starting in the Q1 high season, going all the way through the rest of the summer. And then we see things really be difficult in Q4. Now, if we look at the highest performers, we again see a very similar situation. While there is a little bit of pressure on the occupancy, top performers are really able to maintain occupancy levels quite a bit better, at least until we get to the summer where that gap widens a bit. And then again, even though the top performers have been able to maintain and still have a higher occupancy, we're seeing pretty significant shortfalls in Q4, but they're still taking a lot more of that market share. Now, when we pull up 2026, we do see, let me pull off 2024. We do see we have quite a bit on the books. And again, this is going to look really similar to Fort Myers and Cape Coral. January is behind. It's behind by about 10%, which I would say is pretty substantial given that there's only 16% on the books. Last year, we were about 25%. So January is probably going to have a significant shortfall. You really need to be fighting to get your occupancy here in the remaining 2 weeks of the month. For February, flips. We're pacing ahead when we look at February, but this amount we're pacing ahead is not quite as high as we saw in Fort Myers. So while we're still pacing ahead about 5%, it's about half the increase we had before. So a little bit more competitive, but still looking pretty good. Same with March. We're about 5% ahead. So we're looking pretty good, not quite as good as Fort Myers, but pretty good signs there. And then we do see some bookings on the books early. Now, we're not seeing quite as much as we saw in Fort Myers and Cape Coral, but we do see some early booking, which is a really, really good sign. When we look at the highest performing groups, we also see a similar kind of trend that we saw in Fort Myers, which is that pacing loses some ground in February. So it seems like those highest performers are maybe gambling a little bit to try to get a little bit more in February, although March still looks pretty good. I'm wondering if that's really a good move for them. It really could come down to if you think January is going to be more of a trend where the short term kind of gets a little volatile, in which case gambling on the pace for February and March could be a risk. However, if you think that January is just kind of a fluke, it's just low, but February and March is going to come in strong, then you probably will see, that that this is not so much of a gamble. That's kind of up to you. I would say that one of the things to think about it, we talked about this Canadian travel, is professionals have an ability to get travelers from everywhere else, but it also presents a risk, right? Because you depend on them. So if you're relying on high rates to come in, it may not come in from the same sources, whereas those people that are just, hosts or getting their bookings in on the OTAs, they may be taking your market share because those people are actually just looking for the cheaper rate. Something to consider, but this is kind of a big risk here, I think. And the difference between the high performers not quite pacing ahead versus the market itself pacing ahead means that there's some mismatches going on, and you really got to be aware of your own pace when you're making this decision. If you're pacing well, that's going to give you more ability to take some risk on ADR. If you're behind pace and you know the market as a whole is ahead, that means you are just missing out on bookings that are coming in, and you need to make some adjustments. Now, let's take a quick look at asking rates between 2024 and 2025. We're going to see a pretty similar trend here. to what we saw. Generally speaking, honestly, nationally, this is a trend that we see when we look at whole market. Generally speaking, our industry price is a little bit too high. Now, the market did adjust rates a little bit in Q1 to try to get that demand, but then remained a little higher through the rest of the year. Now, it's not as high as I thought it would be. These are pretty reasonable given how inflation is. But considering also that occupancy was down, usually you expect the market to be a little bit more reactive to the consumer here. Because what this means, if you're just following market rates, the consumers aren't buying them in as much volume, so you probably need to go a little bit lower. And if the market isn't doing it, that's a big opportunity for you, because if you just undercut the market a little bit, you can take that market share. Now, when we look at the highest performers, we see a little bit similar, but you do see a little bit of what I'm talking about. Q1, they remained a little bit high, but as we get into these periods of the year where things were really, really tough, you actually see that the highest performers started cutting their occupancy, or started cutting their advertised rates below what they did last year. And that's probably partially a reason why they were able to take so much more market share compared to the market as a whole. Now, when we look at 2026, we see kind of similar trends to 2024, 2025, which is people are generally just keeping their rates pretty high. And again, this is probably something that is good for, February and March, given that we're pacing ahead. You can maybe command a little bit in this early booking window, but even January is still high, even though that market is pacing behind. So it does indicate to me that the market is not quite reacting very quickly to what the consumer is doing. Now, let's take a look at the ADRs just to see if we see a similar trend here. When I pull up 2025 and 2026, and I'll also do 2024, this is the most interesting thing. So let me go back here. We have really, really high February advertised rates. It's quite a bit higher than last year. When we look at average ADRs and we look at that relationship, they are still higher. So this pacing that's occurring in February and March is looking really strong. And it is coming in at a higher ADR, although for February, that ADR isn't quite as high as how much the market is actually advertising higher. So the people who are getting booked at a little lower rate than the kind of like market average rates. Now for March, that's a little bit different. March is still pacing ahead. Not only are advertised rates pretty high, but ADRs are pretty high too, so you might feel pretty safe in keeping your rate position in March, but for February, you might need to start to be thinking like, hey, do I want to undercut the market a little bit? Does that make a little bit of sense for me to try to just take that market share? Now, as we get a little further out, I think it's really interesting. You can see out here in like May and June in particular that those ADRs are quite a bit lower. Whereas when we looked at the asking rates, they're quite a bit higher. So it does look like those early bookings that are coming in a little further out are coming in at lower rate positions. And so if you want a piece of that, you may need to be making some adjustments now and really just get your rate in line to make it realistic. I think a reminder here is the goal is not to follow the market. The goal, or not to optimize to the market. It's part of the goal. The goal is really to optimize to the consumer. And sometimes the market itself isn't optimized and it's hard to tell. In this case, I think you're probably pretty safe in March right now because what's being purchased is similar to what's being advertised. For February, you need to start thinking because what's being purchased is a little lower than what's being advertised. And in January is behind. So the guests aren't purchasing enough and the rate is high. So those are a few situations that hopefully you can glean out of this and start to think of your strategy going forward. Now, let's just cover this last one. I'll go through this one pretty quick because, frankly, I think we're going to see pretty similar trends. It's also a much smaller market. But when we look at Rotunda West, we've got 3,700 listings. I'll pull up this year's data. First main difference here is January is not quite as strong as we see in the other markets. This Q1 high season seems to start a little late. It maintained a little bit in January before it started to drop in February and March. And then we see these shortfalls through the rest of the year, with September and Q4 being pretty substantial shortfalls. When I pull up the 2026 data, again, we have pretty good bookings on the books, but pretty similar situation. January is down, right? So we're down about 10% in pace. February and March are both up. February is only up about 3%. So we're getting really close. We're not up that much in February. It means you really got to be thinking about this, right? Because, when we looked at Cape Coral, when we looked at Naples, they're up quite a bit. There's a little bit of space, a little bit of room, even though we're running low on time. to kind of make a decision about your ADR. Here, you really need to be clued into your pace. Because if you're pacing behind, you may need to make some substantial changes. If you're right on the edge or just a little bit ahead, be aware that the market could flip from being ahead to behind very quickly, and that's the gamble you're making right now. When we get out into March, though, we actually have a pretty big lead. We're about 10% ahead, so we're kind of in line with these other markets. Pretty substantial lead in terms of pacing, and quite a lot of time to make decisions about what's going on. Now, let's take a look at the asking rates here. Look at 2024, 2025. This one's pretty interesting because the market was actually quite a bit more conservative, particularly in Q1. We're not pushing rates too high. We were pushing rates out here a little bit through the summer. And then Q4, I think, is pretty unoptimized. Part of this might be because occupancies are so low that a lot of people really just don't bother to optimize, but rates are substantially higher than they were year over year in terms of what was being advertised, despite the fact that occupancy was honestly quite bad. What this means for you is that I think, not everyone is going to try to optimize every time, but if you're a professional, there's just a lot of space for you to take market share. Right? There's a lot of space for you to take the bookings from the people who aren't taking it that seriously. And the key is just getting your rates in line, kind of with where you were historicals. I think a good rule of thumb is look at your historical averages for your bedroom counts and just make sure your rates within 10 or 15% of those at the monthly level. If that's the case, you're probably putting your best foot forward to get those early bookings and to really just beat everyone else on occupancy, particularly when you're in these lower seasons. Now, when we pull up 2026 rates, you can see that kind of interestingly, the market is pushing really high rates here. This is an area that may have been much more affected given that it's a little further north by some of the hurricane stuff last year. So to some degree, it may make sense that there's higher rates. But, to me, looking at this, January being much higher on average advertised rate means that the market's not very well optimized for January. February has a really, really high rate, which has probably been good for good early bookings, but it's probably going to change very quickly because we're only on the edge of pacing ahead. And then March is looking pretty good, right? Advertised rates are high, but so is pacing. Now, when we pull up ADRs, we can see that trend's kind of continuing, actually. So March is, people are really being rewarded in March, pushing that rate up higher. You probably can continue that until you see changes in your pace. January ADRs are a little higher. But given that the market is pacing behind, I think the wise thing to do would be to really shift to an occupancy-oriented focus and give up some of that ADR to just fill as many room nights as you can. And then February is the decision point. It's right on the edge. If the market starts to fall behind, having the high rates could be a liability. If it maintains its slight lead in pacing, then you're going to be rewarded for having these higher ADRs. I can't tell you what your risk tolerance is here, but I think your really big decision point right now is what are you doing with February and what are your markers to be concerned about March or to change your behavior in March? Okay, well, I hope you guys really found that helpful and interesting. We'll be doing more of these throughout the year, so we'll probably check in after the high season just to see how things have come together. We'd love to have you on here. It's a great opportunity when we invite folks to also give their opinion on what's going on in the market and their portfolios and really to coordinate if we're all seeing kind of similar things. Just a quick reminder, all of this data that I showed you is in Wheelhouse. These market reports, which we can see things at a very high level, are actually freely available to anyone. All you have to do is sign up for a free Wheelhouse account. And you can access the market data. I also mentioned a lot about checking your own pace. Wheelhouse offers free tools to see your pace compared to last year, same time last year, and market data. And those tools are all free. All you have to do is connect your PMS. You don't have to pay us, but you'll be able to see all of your pacing by month and actually take that all the way to the daily level to see exactly what days are behind or ahead of pace and where you're making sales. It's a great view, and we do offer free training. All you have to do is let us know and sign up and link your account. Awesome. Well, I hope you enjoyed this, and I look forward to seeing you again soon. Thanks. Bye.